End of last year. Were you guys one of these people, if you're already investing? End of last year, not super fun, and that was a really good demonstration of the roller coaster that is the share market. It's some really overused cliche saying that the share market is a roller coaster, but it's an overused cliche for a reason. It is. So I'm going to keep overusing it again. The trick to investing is that you have to stay on the roller coaster the entire time. Arms and legs inside the vehicle. Do not try to jump off early. You will get flattened. The share market is what we call a long-term investment. So you will hopefully be putting your money in there for at least 5 years. I would say more like 10, 20, awesome. You don't touch it. If you do that, you will get a really good return, probably. Nothing's guaranteed. But generally, the share market goes up 7 years out of 10. You do not want to yank the money out on the 3 years when it's going down. You do not want to need that money. So, this is a handy little chart of the New Zealand market showing exactly that. So thank you to the Financial Times, by the way. I totally ripped you off. And it only goes back 5 years, right? So you can't see the doomsday that was 2008, but you can see a little bit around July, is that 2016? Again, that's the tail end of last year where I'm sure a lot of people were not having a great time. But look, after that July 2016, if you stuck in there, you made a whole bunch more money back. If you jumped out at that point, you locked in those losses, right? When the market goes down, it's going down on paper. So you need to be emotionally prepared for that because your emotions can be one of the most dangerous things for your investing future. If you panic and sell, you've locked in the bad price, you're selling cheaply. That is exactly what you don't want to do. So, why am I telling you this? Because I really want you guys to be successful investors. That's what my podcast is about. Well, it's about all sorts of things to do with money, but also investing. And if you want to be a successful investor, you need to put your ego aside, you need to put your fears aside, your emotions aside, and you need to do less. A really common mistake people make is it feels like to be a good investor, you should be doing a lot of things. You should be doing your research on companies, you should be moving around, you should be buying low and selling high. Yes, but that's really difficult. I'll come back to that. Please consider passively staying on your one roller coaster. Do not get off, but also don't try and jump onto a new roller coaster. Just stay there. And this is where we talk about active versus passive investing, which can get heated. And I'm going to nail my colors to the mast. I think that you should passive invest. Active investing is picking winners. It is picking a few companies, doing all your homework on them, putting your money into them, selling for a profit, doing it all over again. It's not the best idea for most of us. Now, if we could all buy when the market's low and sell when it's high, we'd be millionaires, clearly. You'd also probably be this chick, which we're not. We can't see the future. Even if you've done your research, you're still saying what you think that research means for the future. And actually, if you've done all your research, you'll find out that active investing is really hard and very few people succeed at it. So if you say you've done your research and you're going to actively invest, I doubly don't believe you. On the other hand, passive investing. That's the idea where you buy into the entire market, right? So funds, to take some examples of what Sharesies has, you might buy the top 50 companies in New Zealand, or you might buy the top 500 in the US, because they're slightly bigger than us. Some of those global funds even, you spread your money around really, really widely, and you're effectively buying into the entire economy. So one individual company might fall over. And if you've bought into that one company, you're in trouble. An entire economy is probably not going to fall over. The entire economy usually grows. And that's what you're betting on when you're passively investing. You're betting on something that is almost certainly going to happen. That's what you want to do. Then you want to do nothing. And I'm not saying that based on personal preference. I'm saying that based on evidence. So, Wall Street Journal published research in 2016, found between 71 and 93% of US mutual funds, now that's actively managed funds managed by professionals, were beaten by the closest comparable index fund over 10 years. So that's the results of a professional against passive investing. And I'm not saying that the people who manage funds aren't smart, because they're really smart. It's just that active investing is really hard, and most of us can't do it. I'm not in the top 7% of financial minds. Probably most of us aren't. And I also can't bet that I can find the active manager who is in the top 7% of fund managers. They'll all tell you they are, but are they? So index funds diversify away the idea of you having to pick a winner. Instead of trying to find the one company that will beat everyone else, you're betting on the economy, which almost always goes up. As a cheap-ish investment that you can set and forget, it's hard to beat. There's also a 2018 study by the Bank of International Settlements, which went as far back as 1968 and as recently as 2014, compared a bunch of studies there, and almost all of them said passive investing is the way to do it. Just spread your money around and leave it alone. The key ingredients are time, doing your research at the beginning, spreading it around, leaving it alone. But you might want something really recent and from New Zealand. Okay, so the tail end of last year, bit of a nightmare for those who were investing, I'm sure you saw. Values fell a lot further than they had for a long time, and supposedly this is the active manager's time to shine. A lot of them will say, okay, we might not always be able to pick winners, but when the market goes down, we'll protect you from it. So, in the last quarter of 2018, how did they do? Now, this is from the NZX, and that blue line in the middle is the one to beat. That's your market average, right? The green are passive funds. The white is not. So the entire market fell by 5.8%. 9 funds beat the average, only 2 were active. 15 did worse than the average, 14 of them were active. Now it's 1 quarter of the year, I do want to be fair, it's a snapshot. But combine that with the other research I mentioned. And you're starting to see that for almost all of us, the path to getting wealthy, staying wealthy, is passive. It's doing less. Now you can buy into as many index funds as you like. Think of your money like a group of friends going into the theme park. They can ride different roller coasters if you'd like. My personal opinion, and this is a personal opinion this time, is that it doesn't matter so much what you invest in. What matters is that you are investing, that you're investing widely, and that you leave it alone. But don't switch roller coasters mid-ride. So do less, and do it over as long a time as you can, because the other trick to passive investing is compounding. So the longer the time you have, the more you can compound, and it's basically, you're thinking of it like a money snowball. You earn some money, it goes back into the pot, it starts earning you more money, it's all building up and packing in, and before you know it, you have far more than you started with, and it's all working hard for you. You just need time for that money snowball to roll further and get bigger and all pack in there. Which brings me to a little bit of a terrifying slide, and if you are slightly older and have only just started investing, it will get nicer. This is what time can do for you. Okay, so credit to Business Insider. They took 2 hypothetical savers, Emily and Dave. Emily starts at 25, Dave starts at 35, and they both put in $200 a week. And they got about a 6% return per year, which is a fairly reasonable thing you can assume. And by the time they retire, Emily's put in $96,000, Dave's put in $72,000. She's put in a little bit more money, not that much more. But because of compounding in time, she's got twice as much money at the end as he does, just from an extra 10 years. That's the power of compounding. Put it in, leave it alone, give it time. Now, if you're 35, or 45 or 55. Please don't feel bad about that, because think about how bad the line might look if you started even further back. Here's the big thing I want to leave you with. Best time to plant a tree was 20 years ago. Second best time is today. Thanks. People, I think it's that big one where people always feel like they should be doing so much more. It's a really common thing. You feel like if you put in more effort and you put in your homework, then you get paid back more. And I think, yeah, in most areas of your life, you work harder, you get more. It's just not true for investing for the vast majority of us, unless you are a savant. And I don't see Warren Buffett in this room. I just think if you can do less and you can put your ego to the side, that's when you do well.
And the great thing about Warren Buffett, he's a massive supporter of
yes.
Passive investing.
Yes, exactly. I've talked to a lot of industry professionals about this, and it's really interesting in terms of the ethical and environmentally minded funds. Is that the sort of thing you're thinking? And their idea is basically that it's really great in terms of if you can feel emotionally like you're doing a good thing, you're more likely to invest. You know, that's just my cynical point of view on it. Another cynical point of view is those companies are usually the ones that are here for the long term. You know, it used to be that sin was in, but petroleum companies aren't making the money they used to. The ones that are the ones that are pivoting to clean energy. Tobacco isn't making the money it used to. A lot of the sin companies are considered sunset industries. So I think it's a really smart investing move to be looking at sustainable, ethical companies. And it's also kind of nice for the world.